Right now, something is quietly repricing every single asset you own. Your stocks, your bonds, your retirement account, even the value of the cash sitting in your savings. Most investors have no idea it is happening. By the end of this video, you will understand exactly how the trade war functions as a hidden tax on your wealth, why the strategies most people are using are making things dramatically worse, and what the investors who are actually coming out ahead are doing differently. This is the briefing Wall Street wishes you never got. You checked your portfolio last quarter and something felt off. Maybe it was down 5%, maybe 10%. You told yourself it was temporary, just noise. But then you checked again, and every time the explanation was different. Tariffs on steel, then semiconductors, then agricultural goods. Your instincts were right. Something structural was shifting beneath the surface of every market you are exposed to, and the financial headlines were only showing you the ripples, never the stone that caused them. Here's what nobody tells you. You do not need to own a single share of a Chinese company or an American exporter to be deeply exposed to this trade war. If you own an index fund, you own supply chains. You own companies whose profit margins depend on components priced in foreign currencies, assembled in countries now facing new tariffs, and sold to markets that are retaliating with restrictions of their own. The globalization premium that inflated equity valuations for the last 3 decades is now being unwound, and it is coming out of your returns. The conventional advice right now is to diversify more broadly, add some international exposure, maybe rotate into defensive sectors, hold a little extra cash. It sounds reasonable. It is the answer every financial advisor gives because it is the safest thing to say. But here's the problem. This trade war is not a sector rotation story. Spreading your bets across more of the same global system does not protect you from a restructuring of that system itself. You are rearranging deck chairs, and the ship's architecture is what is actually changing. There is a reason this keeps happening that nobody in mainstream finance wants to talk about openly. Every major trade conflict in history, from the Smoot-Hawley tariffs of the 1930s to the US-Japan semiconductor disputes of the 1980s, produced a new economic geography. Winners and losers were not determined by who panicked or who diversified. They were determined by who understood that the old map was obsolete and started navigating by a new one. The investors who are quietly building wealth right now are not reacting to the trade war. They are reading it. Here is the core mechanism. For 30 years, global capital flowed toward the lowest cost producer. That model built a world where your iPhone was designed in California, its chips fabbed in Taiwan, assembled in Shenzhen, and sold everywhere. The trade war is not a political argument. It is a forced reversal of that capital flow. Governments are now paying enormous sums to relocate production. That relocates profit margins. That relocates which companies grow and which stagnate. Every portfolio built on the old flow assumptions is now priced for a world that is being actively dismantled. Look at the data from the last major trade restructuring. When the US-Japan semiconductor deal reshaped chip economics in the late 1980s, the investors who tracked policy flow, not earnings reports, caught the South Korean semiconductor wave a full 5 years before it became a consensus trade. Samsung was not a mystery. The tariff schedules made the outcome nearly inevitable. Today, the same dynamic is playing out in Mexico, India, Vietnam, and in domestic US manufacturing. The map is being redrawn in public documents that most retail investors never read. The behavioral contrast here is striking. Average investors respond to tariff announcements by watching their portfolio app more frequently, reacting emotionally to price signals that are themselves reactions to policy signals. Sophisticated capital allocators do the opposite. They map the policy first, model the second-order effects on supply chain margins, and position before the price signal arrives. One group is reading the scoreboard, the other is reading the game clock. That difference in timing, measured in months, not seconds, is where generational wealth gaps actually originate. Here is the reframe that changes everything. Stop thinking of the trade war as a risk to manage. Start thinking of it as a map being drawn in real time. Every tariff announcement, every reshoring subsidy, every bilateral exclusion list is a coordinate on that map, telling you exactly where capital will be forced to flow over the next 5 to 10 years. The investors who are winning are not smarter. They are simply reading the map instead of staring at the weather. One is a policy document, the other is a daily price chart. These are not the same thing. Principle 1. Follow the subsidy trail, not the headline. Governments are now openly publishing where they want capital to go. Through the CHIPS Act, the Inflation Reduction Act, EU industrial policy, and India's production-linked incentives. These are not suggestions. They are trillion-dollar commitments that will reshape profit pools over decades. The companies and regions receiving these subsidies are not guaranteed winners, but they have structurally lower risk than companies whose business models depend on a supply chain that no government is currently subsidizing. Principle 2. Reassess your commodity exposure specifically through the lens of strategic materials. This is not a generic commodities trade. Copper, lithium, rare earth elements, and domestic energy are the physical infrastructure of supply chain reshoring. When a government commits to building semiconductor fabs or electric vehicle plants domestically, it is writing a multi-decade demand contract for those materials. The investors who understood oil in 1945 understood that energy was policy adjacent. Strategic materials today occupy the same position in the new economic architecture. Principle 3. Currency exposure is now a first-order decision, not a footnote. Trade wars are currency wars with extra steps. When a major economy imposes tariffs, the affected country's central bank often responds by adjusting monetary policy in ways that devalue or revalue its currency. If your international holdings are not currency hedged or selected with explicit currency risk awareness, you may be capturing the equity gain in the foreign market while simultaneously losing it in the foreign exchange translation back to your home currency. This is the invisible leak in most global portfolios. Now here's where most people go wrong when they try to apply this thinking. The first mistake is binary positioning, going all in on reshoring plays or completely abandoning global exposure. The second and more dangerous mistake is confusing the political timeline with the investment timeline. A policy takes years to translate into earnings. Investors who buy the reshoring theme and then sell at the first earnings miss are not playing the right game. The third mistake is treating every tariff escalation as symmetric. Not all companies in a tariff crossfire are equally damaged. The supply chain audit is the work that separates real positioning from noise. Here's what to do in the next 30 days. First, pull your top 10 holdings and identify which ones have greater than 30% revenue exposure to tariff-affected trade corridors. That is your real risk map. Second, allocate 1 to 2 hours this week to reading the latest USTR trade policy report and your country's equivalent. These are free, public, and devastatingly underread. Third, evaluate whether your international equity exposure is currency managed or just currency assumed. If you do not know the answer, that is itself the answer. None of this requires a new broker. It requires a new reading habit. Here's the question I want to leave you with, and I genuinely want to know what you think. The conventional wisdom says trade wars are temporary disruptions that markets eventually absorb. But looking at the scale of semiconductor subsidies, energy infrastructure commitments, and the bipartisan consensus in multiple major economies around strategic decoupling, some serious analysts are arguing this is a permanent restructuring, not a cycle. If they are right, the entire framework of passive global investing built over the last 30 years needs to be rethought from scratch. Are we in a disruption, or are we watching the old world order permanently close?